Welcome to another episode of Tank Talks, your personal think tank for all things startups and venture capital. I'm your host, Matt Cohen, founder and managing partner at Ripple Ventures. On today's show, you will hear an episode I recorded as a guest speaker a few weeks ago with Justin Gordon from the Vitalize podcast. Justin and I chatted about all the different facets of Ripple and what sets us apart from all the other early stage venture capital funds out there. I share with Justin why we decided to launch an incubator space as a first-time venture fund and how we were able to transition to a remote world during the pandemic. Lastly, we talk about the current venture markets and how our concentrated approach to investing has led us to launch our current Fund 3 and how our Ripple X Fellowship program is shaping the next generation of venture-backed founders and funders. Now let's jump into the tank for this week's episode with myself and Justin Gordon from Vitalize.
Matt, welcome to the show.
Thanks for having me, Justin. Really excited to be here.
Yeah, I'm excited to chat with you. There's so much going on, it seems like, at Ripple. From like the research, there's many different facets. So I want to set the stage with that first. What is all involved at Ripple? Because I started looking at this and I was like, wait, they have this going on, they have this going on. For people who don't know Ripple, like what are all the facets of Ripple?
Basically, we're a fund that just doesn't sleep. At least that's what I tell my wife. But no, I mean, to think about Ripple is a way to think about sort of the differentiation between just like capital and then that value add you hear from a lot of VC funds. We get into like how the sausage is made and do it very transparently. So, when I started the fund in 2018, I had already spent, over a decade working in public markets and capital markets, had a lot of exposure to sort of the public realm of how businesses were being viewed and operated, but never really understood the early stage side of it until I actually started a company with two friends of mine back in 2012. And so through that journey of bootstrapping a business, begging and boring and trying to get our way to profitability, which is a crazy thing, I learned the hard way of how to pitch 300 investors and get told no, and then still go through the journey of having a successful exit and selling a company to Yelp and seeing that become what it was, taught me a lot about how to build businesses from the ground up. And so when I started Ripple, I really went out with this mindset of like, I don't care if anyone else doesn't believe in this founder. I think I believe in this founder and I don't need anyone else to do the work with me. So we're going to roll up our sleeves. We're going to create the infrastructure. We're going to create the templates and the guardrails to help them get out of that death valley, which so many startups fail in. The percentages of companies going from, first funding at the pre-seed round and getting it to a Series A are like, 90% fail. So we wanted to be able to say, hey, we think we have a way to get through that death valley. It's not going to be easy. It's not going to be like turnkey, but we can put up the guardrails to get you through that more successfully. And I think we've proven that with our first two funds. And so that's sort of the way we think about it. And to summarize, it's like Ripple Ventures is the preeminent early stage venture fund that is trying to build and back enduring and resilient companies. And resilient is the key word there, because in this time period, right where we are today, resiliency is the only thing that matters and will keep you alive. So that's the way I like to summarize it for people.
Let's unpack the resiliency side of things. What does that mean for companies? Founders are going to hear that. Like, what do you mean by resilient exactly in this context?
I mean, first and foremost, it's like, don't take no for an answer. Number one. Number two, it's like, do the actual work yourself and don't actually pay other people to do the job you should be doing as a founder. So what does that mean? It's founder-led sales. It's founder-led fundraising. It's founder-led hiring. It's founder-led, product building. It's all of that at the early stage. Because at the end of the day, what I tell founders, like, you really don't have a lot of risk here, unless you're bootstrapping the business and you've mortgaged your house or something. But really, it's us as the VC fund who's taken on the majority of the risk. For you, yes, it's your company, but you could probably go get another job somewhere. You left probably a job to go build this and take a chance. So all you're risking is the fact that this just won't work out, and you can go back to maybe an accounting or a consulting job if this doesn't. For us, it's like a big chunk of our fund, a lot of our time. It's the only asset, technically that we have that can work. We're not invested in the public markets or diversified in real estate. It's all about you. So we're putting all of our eggs in your basket and trying to get you to succeed. And so resiliency is really saying, hey, how am I going to actually take all of the noise and the signals that I'm getting from the market and try to hone on something that's going to create value for a lot of the hopeful customers that I eventually want to sell to when I have product solution and then eventually product market fit. So when we started Ripple, our podcast is called Tank Talks. And the reason why it's called that is because we had an incubator space called The Tank, which we can get into. But really, that was an incubator space that I started at the beginning of Fund 1 in 2018, 2019. We had 50 desks and 50 chairs. I built every single one myself. And I brought our portfolio companies in to work alongside us day to day. And why we did that by taking on the real estate risk and all the overhead costs associated with it was we wanted to be working alongside founders, rolling up our sleeves and say, hey, you got a problem? Let's not wait for the monthly update or the quarterly board meeting to do it. Let's talk about it right now. Let's get into a room and we can help do this with you as an extension of like your founding or management team. So that's sort of where the whole hands-on approach started with, was physically working in the same location with our companies.
Okay, when you started the fund, do you know like right away that was going to be what you wanted to do? I know you're very hands-on. You mentioned, I didn't say this, but I saw it in the research. You like to lead rounds. You like to take board seats in like 70% of the companies or something like that. And so when you started this, knowing you're going to start Ripple, you're going to have a physical space with founders, which is not the norm ever. Just take me back behind that decision and be like, yeah, we're going to have a physical space. You tell your LPs like, yeah, there's some capital is going towards a physical space for these founders. Just say either more of that, because I like seeing the difference in structure and like strategy for VCs. So I'm curious about that decision.
It was definitely a hard sell to our LPs, but like I told a lot of people, it was my own fucking money in Fund One.
Yeah.
Like I put a lot of my own money into this fund. The GP commit was like 1/3 of the total capital committed. So it was a meaningful skin in the game sort of conversation. We had already had 2 portfolio companies rolled into the fund that were my angel companies that I, put as my LP commitment, which were serious like LP commitments that I rolled in at cost. So there was a lot of like alignment with our LPs. And when it came to sort of this, incubator space, it came around because we said, there's all of these early stage funds out there giving capital and saying that they're value add, but how many of them are really there day to day? And so what we decided to do is, hey, let's bring this company and these companies together alongside us and then build a team of support around them, like a fractional CFO, a PR and marketing coach, a CEO coach, a Salesforce implementation partner, people I knew through the ecosystem that could meet in a physical place before the pandemic and be like, hey, I'm going to spend an hour with you. It's not going to cost you anything. I'm here because I'm a friend of Ripple's. But I think like we could actually get some real work done. And that to us was the only way where we could actually see things being created and valued. And then the ripple effect that happened was just companies were bouncing off each other, right? Companies who were succeeding were sharing those tidbits with the companies that were a little slower to growth. The companies that were struggling were watching the company succeed and be like, I want to sit down with that founder right now over lunch and talk about it. And then the tank talks happened because we started having people in the city of Toronto coming into the physical office space, giving talks on community and growth and hiring and firing and all that stuff.
Okay, wait a minute. You mentioned physical office space in person. Obviously, the world has shifted a bit. How has that shifted? Your whole thoughts on this mentality behind that? I'm curious.
I mean, geez, I think first off, like nowhere did I ever think I would be caught into a massive 5,000 square foot lease with nobody sitting in it for like months on months. And fortunately, after several months of stressing out, because the buck stopped with us in terms of the cost with the landlord, we were able to actually find someone. Our next door neighbor was a friend of mine in the building to take over our lease, which we had like 3.5 years left on. So it was a tough process, but we got out of it. No real battle scars, and we moved into a virtual world. Now, the great thing about how we set up the physical office was that we built a lot of infrastructure around communication and async communication, and then templates around supporting founders. So when we went to into COVID and how we had to be remote, we were really well set up. We had our entire portfolio companies and their employees in our Slack channel called The Tank. We had all these monthly check-ins, bi-weekly check-ins with founders. We had these onboarding programs for our early stage companies. We had these events that we were just transferring into the remote world. We didn't really have to play catch up a lot. And we had the podcast. And so there was just a lot of async communication really built into our framework already so that we were ready to go when everything was shut down. So it really wasn't that big of a transition for us. Even our LP meetings, we had started transitioning to an LP Zoom meeting instead of in person because we had so many LPs that were outside of Toronto, outside of Canada. So it wasn't too big of a heavy lift for us. The hardest thing was just making investments for companies we had met before. But luckily, we had made a few before the pandemic where we hadn't met the founders in person. So the transition also wasn't that hard for us.
Yeah, you had a taste of that at least beforehand, which was nice. I'm curious too, you mentioned obviously all the things you do to help founders. You have the in-person space before, it's evolved since then, but I think you had tweeted out recently that you gave a talk on like founder mental health. I'm curious on how you approach that from the VC perspective in terms of helping your founders, giving them the resources, directing them to people, what you tell them, because obviously you're working hand in hand with them on that whole topic because it's such an important topic. I'm just curious on your thoughts on that too.
Yeah, I mean, this is a real sensitive topic for me. I always get a little teary-eyed when I think about it because I've seen founders that I work with closely like just totally shut off and close down without any signs. And we should have seen the signs. We should have seen that they stopped giving monthly updates or stopped talking to some of their employees openly or even their investors. And so for me, when it comes to supporting founders with mental health, it's really about explaining them, number one, we're already investors in the business and we're sitting now instead of across the table from you on the same side of the table as you. So we're totally aligned. And then the second thing that I always make sure people understand is it starts with empathy. It starts with understanding the situation these founders are going through, not just in their professional lives, but in their personal lives, whether something's going on with their partners, their family, somebody's sick, there's a stress that's coming from outside the organization that you're just probably not being mindful to. And most investors just don't give a shit. It's like, it's not my problem that you have, relationship problems or something else going on in your family at home. It kind of is, though, your problem is what I tell them, because founder flight is the biggest risk at the early stage companies. At the Series A, B, C or something, there's infrastructure, there's a team, there's plug and play, a lot of things on the operating side. But at the early stage, it's all people, it's all founders, it's all early management team members and things like that. So you need to care about founders' mental health. And so what I say to a lot of people is, let's not jump at every single bad sign in the company's operating business or lack of communication. And let's peel back the onion and try to get to a point where we understand why they're so bad at certain things. So when I notice founders are slacking on their monthly updates or just their async communication with us, I don't just jump at them and say, where the hell is this update? Or why are you so bad at telling me what's going on with this partnership agreement? What I do is I send a text message or I jump on a phone call and I'm like, hey, do you have time for a coffee or a beer or dinner? Let's just go talk about, family and life. And then naturally the conversation comes up I got to ask, I've noticed that you're slacking a little bit on these things. Is something going on? And they say, yeah, you know what? I just don't really understand this. Or I'm feeling imposter syndrome towards some of these things that we've been promising our customers and we're just really slow at getting it out. Or the worst is I'm having problems with my co-founder and I don't know how to deal with it. And so we need to get to those kind of real transparent conversations and authentic conversations with our founders early on, because it's going to eventually, blow up in your face when it really matters, like at a Series A fundraising round. And so that's where it's sort of come from.
Yeah, there's so much to go through with that. And that's such a huge part of obviously the relationship between founders and investors and working with them as you go through these challenges that are inevitably going to come up in some capacity, in some way, shape, or form. I want to switch gears a little bit in terms of talking about the market. So markets have been shit, let's just say that much. With that in mind, what are you seeing in the market? How has that changed how you operate, if at all? How you advise founders? Because everyone has a little different take. I'm curious, Matt, what's your take on that?
Yeah, look, I grew up in the public markets. I saw, down in New York, working on Wall Street, the whole Lehman debacle and, managing, a prop book of business, trading stocks for the bank during 2007, 8, 9. I saw what happened in the real estate market and, that time period as well. And so I come from a bit more of a private equity mindset around capital efficiency, about kind of thinking about building businesses the right way with the right infrastructure, like you're building a house. And so in these markets right now, we've been saying the same message to our investors and our founders at the same time. It's, build consistent, repeatable, skills, build a aggressive, top of funnel, but know that a lot of it is not going to flow through to the bottom line. And so never give up on trying to continue to fill the funnel. Never think that your team is the best team you have. If you have underperformers, you need to get rid of them. I'm sorry, but it's just the way it is. Even Jack Welch says it, get rid of the bottom 20% of your company every year. And so, we are in a time period right now where we're going back to below the line type of investment modeling, which is not just focusing on top line revenue, but thinking about, God forbid I say EBITDA or profitability. Not that we're saying our companies are profitable, but we say to them look, eventually you're going to be judged on the rule of 40. Eventually you're going to be judged on gross margin. So start thinking about those muscle skills right now. So when we go into a board meeting, we ask them to start trying to track a lot of those things at even the pre-seed seed stage, like your gross margin, your rule of 40, your net revenue retention, your customer acquisition cost, your capital efficiency, just so they understand when it actually comes to meaning like great investors at the Series A stage, they understand what they're asking for. And they're not caught off guard when someone says, "What do you mean your net revenue retention isn't over 100%?" You should know about that even early on. And so we've been saying that message consistently. And then the other thing we are trying to get our companies to do consistently also is modeling out scenario A, B, and C. A, obviously top growth, hitting all the metrics. B, medium growth, hitting some of the metrics, but falling short on some. And then C is like default alive scenario. How do you get, out of that and into the other ones? And so we're always trying to say, like, don't just like put your head in the sand and say, everything's going to be great. We don't need to worry about scenario C. You should always have in the back of your mind that little goblin that's saying, "Hey, I'm here to crush you and drive this thing into the wall." And you got to swat it away and be like, "No, I have a plan to get out of there into scenario A and B."
Has it changed at all with your LPs, relationships, conversations with them around any decisions you're making as a GP with the markets?
You know what? We've been so transparent with our LPs since day one, investing now out of our third fund. We've had LPs from fund 1, 2, and 3 now all been with us since the beginning. And so they've appreciated our level of transparency and authenticity. Our reporting has always been focused on like not over marking our book, only taking, third-party priced equity rounds into our valuations. And we just sold a business today, On Call Health, to Qualifax, and that was a great return for us. We wrote out an entire information on exactly how the transaction came together, what it looks like, the DPI, shall I say, that we're going to be paying back to our investors, and all the other things implied that just a lot of investors just don't care to share or just don't think about sharing. I'm an LP myself through my own family office, Ripple Capital, and half a dozen other early stage venture funds to support other emerging managers. And it's a little shocking to see the lack of transparency you get in some of their company reportings and portfolio reporting. So I try to go over and above, and sometimes investors say that's too much. And most of the time, though, it's like, you're right on the mark. This is the best reporting I've seen. So thank you for sharing so much.
I want to get into both those things you just mentioned, the fellowship and the family office, in a second. But I want to go back to one thing with your fund strategy. So you mentioned investing in a fund 3, starting in 2018. What's your strategy in terms of deployment period, how you're looking at that? Because it seems pretty quick.
Yeah, well, I mean, our funds were small, right? So our first 2 funds were $10 million each. And so we were deploying capital in sort of a kind of a 2-year time frame between each one from beginning to end. I'd say we're also very first check heavy when it comes to deploying capital. That worked really well for us because some of the other early stage funds that were writing, let's say 20% of their allocation, saving 80% of their allocation for the total investment in the portfolio for reserves, they were being forced to writing follow-on checks at very high valuations when someone would come in and lead the Series A. And it would just drag your average, entry price up too high to be almost a Series B average, venture fund. So we're very fortunate to see our average entry price into companies be quite low because we are very first check heavy, which means like 70-30. And then from a follow-on investments post Series A, we would just give our pro rata to our LPs, which they loved as well. So that worked really well for us, which I think a lot of funds have now realized like that's probably the better way to do it. So you don't pay up for less ownership, essentially.
Yeah.
For us though, now investing out of our third fund, we've kind of gone back into like the early pre-seed, seed and seed plus stage, writing $250 to $2 million checks. We run a concentrated portfolio, and it's because we roll up our sleeves and like to be involved with all of our companies. But that being said, we also have this Ripple Fellowship program that we've been running for almost 4 years now to be able to support underrepresented founders and future funders, essentially students in university programs across Canada, the US, and now globally, to be able to train them to think about how to run a successful startup company or to be a early stage or venture capital investor one day. And it's generating a ton of great, ripple effects for us. It's seeing great, students come out and get jobs at top tier venture funds, creating a great network for us to rely on. We're recruiting ourselves from the program to find the best analysts and eventually associates. So all of our analysts and associates have come from the fellowship program. And then lastly, the startups that are coming out of it, these students are coming out with great ideas, great network, over 1,000 students they now have been able to interact with across all the cohorts, and they're building real companies. We see students building, companies in the Web3 space and the dev tool space, in traditional consumer B2C, B2B space. And so we've seen over $50 million raised collectively from the companies that have spun out of the program. And so now we've created a fellow fund within Ripple Fund 3 that we're going to invest in these students with 25, 50K US investments on a standard like YC safe note to get them started, get them building. And then what we also do is bring our founders from our existing Ripple portfolio in as co-investors with smaller checks, 5,000, 10,000, make them their own, angel investor network. But they also have skin in the game to want to help these really early pre-seed founders. And that's super cool. The ripple effect of seeing all of that happening with like a Series A, Series B Ripple founder giving back to a very early stage founder, be like, I was in your shoes 2 years ago. This is exactly how I dealt with it. And by the way, make sure my $10,000 turns into $1 million.
No pressure. I want to unpack that a little bit. How did that come about in terms of how that start, this whole fellowship program?
So it started by my partner, Dominic Lau. He's the brains behind it. I was just supporting him and pushing him along to keep going with it in the beginning. I went to a university in the East Coast of Canada, Dalhousie, where we had co-op programs and internships between our second and third year of business school. My partner, Dom, also went to an internship program at the University of Waterloo. We came together and said, look, there's all these scout programs out there which are really focused on deal flow and not too much tangible support and like textbook knowledge on how to actually think about startup building or investing. And so we said, let's make a program where it's fully give first, no expectations, but just give people access to this information and this playbook that we've been sort of building ourselves. And maybe something will come out of it. That's how it started. And it started at Canada, across some of the universities here in Ontario, and eventually the rest of the country. And then we started seeing people telling their friends at universities like MIT and Harvard and Drexel and University of Louisville and Kentucky and all these places, being like, hey, I just did this program called the Ripple X Fellowship. It's amazing. Oh, by the way, I'm an arts major, and now I know a lot about venture capital and startups. Like, there is no pre-bias to like people in business school or people in computer science. It was like open to anyone as long as they were willing to put the time and the effort in to join the program and contribute. And so we've now run 12 plus cohorts. We've got, like I said, 1,000 students in the community. It's a fully online remote program. So when we switched to COVID, it was an easy transition to us. There's video-based, there's text-based, there's project-based. People are finding their co-founders in it. So that was amazing to just see all of that happening. But then what really happened was in Fund 2, some of these founders were coming back to us after they graduated and said, hey, remember that startup I had came to about potentially building? Well, it's actually working now. And I just got 6 term sheets to lead my seed round, and I have no idea what to do. Can you guys help me? And so we were talking and we said, well, why don't we just lead the round? We're the ones who were the ones helping you in the beginning. We know you really well, and we have a venture fund. So why don't we invest? And so, we invested in some of those companies from the fund, like Lula. And then eventually we started seeing other companies getting amazing traction, like Utopia Labs, started by Kaito Cunningham, which is a Web3 platform to help payments and infrastructure for DAOs and Web3 infrastructure companies. And they end up raising $25 million from Coinbase and Paradigm and Kindred Ventures and a bunch of other big firms. We're like, damn, we missed out on that one too. So we decided that we were going to actually put aside a pool of capital to invest alongside or to be the first investor. So that because we had first dibs on these companies anyways, and it made sense for us to be there supporting them. So now they get onboarded like a traditional Ripple company into our Slack channel through our onboarding process, get part of our entire portfolio perks package, which has 25, discounts for all your, tech services and things like that. And so they love it. And then they graduate hopefully into a core position in the portfolio one day, which is a great thing to do as well. So it started out as a really give first approach, helping underrepresented students, mostly, female and people of color. We have 90% BIPOC representation, 50-50 male, female representation. It's really focused on that initiative. And, kids come to us and say, like, I knew nothing about venture capital. I didn't have a family member in private equity. I didn't know anything about banking. I came from a pharmacy background. And now I'm thinking about starting my own tech company because of you guys, which is really cool.
That is quite the initiative. I'm sure we could talk about that for a very long time. I know we're almost out of time here. One thing I'm curious about, you mentioned that there just for a second, but you mentioned Web3 infrastructure. Obviously, we've seen the kind of evolution of Web3 in the last number of months. How do you think about that still, future of Web3, what needs to be done in that? Because you're obviously looking at that intently. I'm curious about that too.
Yeah, so look, we've always had a thesis around workflow automation system and developer tools. In fact, some of our Web2 focused companies have already had some of their products been utilized by Web3 and DAO, programs and platforms. So we've got companies like ZenHub in the project management space, crossing both sides of Web 2, Web 3, Buildable, an events and messaging platform for your database and infrastructure systems already being used by Web 3 companies and for accepting payments and stuff with crypto. So we've already had sort of some of our companies dip their toes into that, but we wrote a thesis on our Web3 thesis, which we do for a lot of our enterprise focus areas. So we take a ton of time to think about where we want to invest, collect a bunch of that information into our research database, and then write a blog post and share it publicly. So we've done it on Web3, we've done it on dev tools, we've done it on employee lifecycle orchestration, and you name it, and DEI as well. So for Web3, the way we look at it is we don't do anything. It's easier to tell you what we don't do. No DeFi, no tokens, no NFTs, any of that. What we're really trying to focus on is platforms that enable anyone to be able to spin up a Web3 enabled service. So you think about like a Twilio, for example, in Web2. How do you create something like that in the Web3 world? Think about anything related to simplifying the onboarding into a Web3 ecosystem that is, universal and could be even white labeled across many different shops, like a Shopify program. So we're trying to take a little bit of what has been successful in Web2 and also being able to scale at way more efficient cost structure into Web3, which is what everyone's really trying to get to. What I try to tell our team all the time is let's not just try and find a problem because it is a Web3 solution, which we've already heard a lot of people talk about. Is a lot of crypto's always been trying to find the problem after they built the solution. And it's totally got to be the other way. And we're a believer in that as well.
I love that. And then one last thing is, I know we're almost out of time here. So the family office you mentioned, looking for kind of these emerging managers, and we've had a number of emerging managers on the show, actually. What are you looking for out of that in terms of emerging managers? Why that involvement into them, as well as the venture fund? I'm curious about that.
Yeah. So what happened, during the pandemic was we were all sitting at home doing, shit all basically. And I was getting a lot of people reaching out while I was still doing my own investing and fundraising, asking me, hey, would love to get on a call and hear about your experience being an emerging manager. I'm like, my experience, I'm still experiencing it. I don't even know I'm in it, if that's what you want to tell you. But then they said, I'd really love to have you as a part of the fund. And it would be great if you can support in any way. And because my fund has always been B2B enterprise SaaS focused, anytime a friend of mine has always come to me and asked me to invest in a startup, I can't do it from the fund. So I had to create, a vehicle, which is, Ripple Capital, to be able to invest in it. So I've done investments in everything from, crypto to cannabis and other things that I'm excited about personally, but I would never let go into the fund. And so I was already doing angel investments. And so I looked at LP commitments as just an extension of that. And so I had given capital to, Austin Reef from Reef Ventures, the team at Bungalow Capital, David Ambrosi and Matt Ziske, the Pioneer Fund, the YC Group, alumni group, invested there. Kirby at Ascend Ventures. I was trying to find people who are like me, building their funds from the very ground up, had a very, interesting approach and outlook to venture capital, and that also could be a great co-investor network and potentially, follow-on investor network for me. If I saw one of their companies break out and I wanted to write a check into a Series A, Series B company, personally, this would be a great way to see a tremendous amount of deal flow. So I've really enjoyed being an LP. I will, in full transparency, say I've had to pull back given the markets, and obviously a lot of my capital and time has been committed to Ripple Ventures. So right now I'm not writing any LP checks until probably next year when hopefully we have some liquidity. But I'm always open to talking with emerging managers, sharing my experience and guidance, and hopefully teaching them some lessons along the way. But capital is one of those things that I just really wanted to support them with as well. As I always say, put your money where your mouth is if you can afford to.
Absolutely. Matt, this has been great. Where's the best place for people to find you online if they'd like to?
Yeah, all on Twitter, Matty B. Cohen, obviously on LinkedIn. You can go to our website, rippleventures.com, and you can check out our own podcast at substack.tanktalks.com.
Awesome. Matt, thank you so much for the time today. Really appreciate it.
Thanks for having me, Justin.
Hey, thanks for listening. If you want to learn more about us, head on over to vitalize.vc. You can also follow us on Twitter at VitalizeVC, or you can follow me on Twitter at JustinGordon212. Have a great day, and I'll talk to you in the next episode.
Thanks for listening to another episode of Tank Talks. To learn more about this episode, be sure to go to Apple Podcast or Spotify to find more detailed notes on this episode or to check out previous episodes. Also, if you enjoyed this episode, please leave us a review and a rating as it helps us out a lot. And hit that subscribe button so you can get notified when new episodes come out. Finally, make sure to give me a follow on Twitter at Matty B. Cohen or at Tank Talk Podcast to stay up to date on new episodes or to be a guest on our show. Till next time,